complicating things, right? This is not just because we want to create more paperwork for you personally or for your business. We want to achieve some sort of greater layer of asset protection, but also on top of that, we want to reduce overall tax that a self-employed individual will pay on a year-to-year basis. Now, remember, a self-employed individual will pay federal tax, state tax in certain states, right? And also that nasty 15.3% of Social Security and Medicare tax, also known as self-employment tax. See, if you had not incorporated this and this business here, you would have paid 15.3% of self-employment tax on the full 100 grand. But under the S corporation, you've actually allowed yourself to reduce Social Security and Medicare tax on upwards of 60% of your business's profit, because once again, you're no longer self-employed, so you're no longer paying self-employment tax. You are an employee, which now self-employment tax has converted to payroll tax. And payroll tax is not on the full $100,000, is it? Payroll tax is only on the 40 grand that you paid yourself. So on $60,000 of your company's profit, you have avoided, not evaded. Remember, tax evasion is illegal. Proper tax avoidance is not. You have properly avoided 15.3% of self-employment tax on $60,000 of profit. That right out the gate in this scenario is roughly just shy of about $10,000 in overall tax savings. I think it's more like $9,200 in overall tax savings. And at the end of the day, what does it cost you to file a corporate return with payroll, with tax planning, with the miscellaneous filing fees here in the state of California? Let's say that on average it costs you about $2,000 to file a corporate return, to maintain it, to run payroll, to file all of the necessary filing fees and the documents each year annually. Let's call it $2,000. Well, I mean, if it's saving you $9,200 on $100,000 in net revenue, I think it makes sense financially. In fact, cut that number in half, drop it all the way down to $50,000 in overall net revenue. It's still going to save you roughly about $4,900 in overall income tax, plus or minus maybe a couple bucks, but about $4,900. That still saves you double what it's going to cost you to file as an S corporation return. What I'm trying to get at is that do not try to navigate the conversation of incorporating on your own. Just because your neighbor or your coworker or your family member or friend incorporated and they're receiving a benefit does not mean that you should go out to LegalZoom or to meet with your attorney and incorporate yourself just to receive the same benefit that this other person did. Everyone's tax return is unique and different in a lot of ways. So incorporating might have been right for them at this period of time, but incorporating for you might not be right, at least at this moment. It might not be right for you because of the investments that you have. If you're only an owner of rental investments and you don't have any property management income, you don't have any self-employed real estate income, what would be the point of incorporating if you only own rental properties, right? Rental income doesn't pay self-employment tax, and the only tax that a corporation like this would save you is self-employment tax. So this would not be for the rental property owners. This would be possibly for people who own rental properties who maybe have commission income from real estate management or real estate sales, or even if you have a little bit of both, long-term rentals and wholesale or rehabbing businesses. I have clients who do both. I have clients who flip property and make a lot of money on the short term, and then they also own long-term rental investments. These particular structures, this setup for them could potentially save tens of thousands of dollars on a year-to-year basis, and over a 5-10 year period, hundreds and hundreds of thousands of dollars in tax savings, which I also equate to wealth retention. I can't stress that enough, that through proper tax planning, you are able to achieve retention of wealth. And that to me is all that matters. To me, in business, doesn't matter how much you spend, doesn't matter how much you make, it all comes down to how much you get to keep. And I consider that to be retaining wealth. So through proper tax planning, you are achieving wealth retention. And that's all that matters. That is the main goal, 1000% goal of proper tax planning. So always remember that. Take control and to kind of flip that switch in your brain to not be afraid of tax planning. It's not like going to a dentist. I know that clients always tell me, they're like, listen, I don't know what I dislike more, going to see you or going to see my dentist. I say, whoa. Okay, first of all, I don't sit here and drill your teeth and tell you that you have cavities and that we got to bring you back next week for a root canal. That's not me. We do open heart surgery and dental work on a tax return. We tell your financial story to the government on a yearly basis. And if we tell that story efficiently enough, guess what? It's going to keep more money in your pocket. And so this is something that's very, very important for you to understand and not be afraid of. You need to sit down and do proper tax planning every year so that whatever you end up cutting as far as a check is concerned, or whatever you end up getting back as a refund, or hopefully you're kind of planning ahead enough to break even at the end of the year to maximize the money in your pocket and not go to pay Uncle Sam. The goal at that point is to get you to pay an obligated amount of tax and not a penny more than your obligated amount. Because like I said earlier, everyone pays tax, but through proper planning, we can control the amount of tax that we pay on an annual basis. Now, what qualifies you for real estate professional status? Well, the government is very specific about what requirements need to be met, what boxes need to be checked off, T's crossed, I's dotted, so on and so forth. The 750-hour requirement happens to be one of the most common requirements that needs to be met, meaning that if you are checking that box on your return that says, I am a real estate professional, literally, there's a box on your return that you check that says real estate professional. When you check that box, the IRS assumes a couple things. They assume that you spend more than, or equal or more than 750 hours working with real property business, meaning that you spend a majority of your time managing property, flipping property, selling property, so on and so forth. You don't necessarily need to be licensed to be a real estate professional. I have many clients who own 20, 30 rental properties, and that's their sole business revenue stream. Well, how can you argue that they're not a real estate professional? They manage a pretty sizable portfolio. They have no other professional income. So at that point, a real estate professional election would need to be made or should be made. On top of the 750 hours, though, you need to understand that the government, on top of their own rules, they kind of throw a curveball at us in an audit scenario. And they say, okay, well, you might meet that 750 hours, but do you meet the 51 rule? And 51 rule is where 51% or more of your time and 51% or more of your income is generated from real estate related activities. And once again, 51% or more of your time is spent working with real estate related business activities. So if you are a full-time accountant like myself, 51% or more of my time is spent preparing tax returns. Maybe 51% or more of my income comes from real estate activities, but 51% or more of my time is spent working as a tax professional. So I would have a very difficult time arguing a real estate professional status. I'm a licensed tax advisor. I have a full-blown W-2 job here. So even if my real estate income was greater than my tax preparation income, I don't think that I would qualify for a real estate professional election. In fact, I know I wouldn't personally. But at the end of the day, if you can meet those two requirements, 51% or more of your income is real estate related income, and 51% or more of your time is spent working with real estate related activities, boom, the election is yours to make. Do not just log into TurboTax and start clicking boxes, okay? Because when we talked about a highly audited form on an individual return, we did not mention what the highest audited election on a return is. So the 8829 form for in-home office and the Schedule C, those might have high audit risks from a form perspective. But when you are making elections on your return to accelerate depreciation, to put yourself under the safe harbor ruling, or to make yourself a real estate professional status, or to click that box and make yourself a real estate professional for tax purposes, understand that this election, this box that you check, has close to a 75+% chance of being audited on a year-to-year basis. Now, why do you think that is? Why do you think this election has such a high risk for audit? Well, think about the benefits that you receive if you check that box. Essentially, any limit, it doesn't matter how much income you make. You can make $10 million in real estate. You can make $100,000 in real estate. It doesn't matter how much you make in real estate-related income. If you check that box, there is no limit to the amount of real estate loss deductions that you will be allowed on your return. Meaning that if all these years you've been making over, let's say, $150,000 and you've seen limitations on your real estate-related loss deductions or any other limits real estate-related wise on your individual return, when you check that box, all of those limits go away. And essentially what you're telling the government is that I am special. I am one of the individuals that is able to make this election fully on my return because I meet this 51% rule or more, okay? So just make sure that before you check this box that you talk with your tax advisor about why or how you qualify to make this election. Last but not least, I want to squash some misconceptions about what has happened already. One, 1031 exchanges are still available. Okay, they have not gone away. I know the Biden administration is talking about getting rid of the 1031 exchange. I don't think this is going to happen. I think they may start to phase this benefit out for high income earners. But at the end of the day, they would be squashing a billion-dollar industry, an industry that creates thousands and thousands of jobs and hundreds of millions, if not billions of dollars of revenue for the U.S. government. So I highly doubt that this is going to go away completely. I think that they will start to phase out some of these benefits for high-income earners. And I truly believe that kind of just along that same common discussion, I think that the Biden administration is really after the uber wealthy of the U.S. I think that that's what they're kind of fine-tuning their tax code to those are the individuals that they want to go after. So I don't think that the 1031 exchange is going away. I think that there will be some alterations of it. At least I really hope I'm right. I hope that it doesn't go away, because the 1031 exchange is very much one of the top 3 benefits built into the Internal Revenue Code, especially for us real estate investors. And essentially, some of these tax benefits that we receive on a year-to-year basis is, one, it allows us to avoid depreciation recapture. That's the whole point, is to kick that can down the road until you kick the can, right? You don't want to pay tax on the capital gain. You don't want to pay tax on the recapture depreciation. So you kick that can down the road until you pass away, and the next of kin receives a property with a full stepped-up basis up to, I think, the $12 million estate exemption that is currently in play, which Biden is also trying to reduce overall. So once again, when we have the new tax code, Robert Hall and Associates, we're going to put together a whole revamped webinar series to bring you all of the current updated tax code changes for 2021. But nothing has changed internal revenue code-wise, okay, as far as Biden's tax code is concerned. This limits capital gain tax, obviously, because you're kicking that can down the road. Through a down leg exchange, when you go from $1 million to $500,000, you can access money to pay off a primary residence debt. You can access money to pay off credit card debt. You can access money to do whatever you like with it, right? Except you do pay income tax on whatever money you are accessing. That's called a down leg exchange. You can acquire more doors. You go from a $1 million one-door Burbank property into 15 doors elsewhere in the U.S. So you can expand your real estate reach. You can win, obviously, more doors equals more cash flow. And also on an up leg exchange, when you go from $500,000, let's say, to $1.5 million, which I've seen some clients do over the past year, you're actually adding value to the building, right? You're going from a $500,000 property valuation to $1.5 million. So you've got increased depreciation expense and also probably a much larger property with more rental cash flow. So as you can see, all of these benefits for the United States taxpayer, I don't see how this is possible. I don't see how it's possible for them to get rid of it completely. I think they will start to alter it and change it a little bit, but I doubt that it is fully going away. And I really, really, really hope that I am correct in this assumption. All right. Just to once again show you that I'm not a one-man operation. We have been serving as a firm all 50 states for the past 50 years. 2021, we